Hey, good afternoon, everyone. Hello. Is anyone there?
Yeah, Keisha Anderson is here.
Yeah, hi, Keisha. Nice to hear from someone, right? I have, I was just shocked because I see only four people in the collaborate, whereas actually I see um, like 14.
So what happened was lots of people were waiting, and then people left because I guess they had to do something, or something might have happened, and then I don't have everybody on WhatsApp, so I can't contact them to tell them that you're actually in the class now.
Yeah, I see like 13 people in the uh, yeah, the total of 13 people in the today's discussion board, right? So yeah, it's only 2:05. I mean, I checked that, and when I joined the collaborate, it was like 2:03. Um, and if you call that, late, technically it would.
I
Uh,
thought class started at 1 o'clock, Professor. If you came in at two
oh,
three,
oh, oh,
then you're
geez,
an hour late.
oh, I'm sorry. What did I think? I thought it was 2 o'clock. Oh,
No,
I'm very
Professor,
sorry.
we start class at 1.
Yeah, yeah. I have a class starting at 2 o'clock Tuesday and Thursday. Oh, gee, I'm so sorry.
Oh, it's
You know
Monday,
what?
Professor. It's Happy
Yeah, yeah,
Monday.
yeah, yeah. I know it's Monday, but because there, Tuesday class, there's a Tuesday class that starts at 2 o'clock. I got mixed up. Oh, this is.
It's okay. You must have had a good weekend.
Oh, yeah. So many things on my mind, and oh, I really apologize. Oh, Jesus, how could this happen? I thought it would be oh, so yeah. If you can, I don't know, if they return, I would appreciate. This is crazy. It's totally my fault. Totally my fault. I'm so sorry. Um, okay. So the class is until 2:40. Whatever, oh, classes from 1 o'clock, on Monday and Wednesday. All righty. So I will I will try to make up. Um, so so look, they all signed in at like 101. Hmm. But then what happened to I had 11 o'clock class, which ended at, did I? No, I ended at 11:55, 56. So there was 1 hour gap in between. And somehow I thought that it was, this class starts at 12 o'clock. Anyway, so let me go back to where we were last Wednesday. So we were talking about the balance sheet and what the balance sheet, um, what was the goal of the balance sheet, right? And the goal of the balance sheet is to explain the capital structure, not the and capital structure is not profit. First of all, it's not about profit. It's about the capital structure. And of course, the accounting people will part partially agree, because in accounting they will say it's to describe, assets versus liabilities and debts, and to describe the components that make up current assets and non-current assets, and but these are already cut and dry. They are not really that's just typical textbook explanation, cut and dry. No particular, no innovative spin about it. I mean, something that you can always read about in the book. But what I'm talking about is before, I said this last time too, before assets, there must be, because assets are use of the capital, right? Before assets, that you must raise capital, and when you raise capital, it's only in two forms, in two types. One is debt, the other one is equity. Okay, so based on these two capital raised, right? You must raise capital first, and then so if you need to start this company, and let's say to start up this company, you need almost $10 million of physical assets, right? Or fixed assets or real assets. So which are plant and equipment. So that gives the justification for raising $10 million worth of capital, and it's either only through equity and debt. So equity and debt are sources of the capital. But think about it. And as I said, assets are the use of the capital, how the capital is used. So in what form they are held now, in what form the capital is held in now. So that's the asset side. So before assets, there was liabilities and debt. Before use of the capital, there must be a source of capital. And what percentage of that capital came from equity? What percentage of that $10 million the capital needed? What percentage came from equity? What percentage came from debt? That's called capital structure. So that was mainly what we were talking about last time, I believe. I hope there are more people now here. At least I have 6 people. Thank you for staying on. So then we need to look into the components. We understand the non-current assets, mainly that's what for any manufacturer, right? The non-current assets, or fixed assets, real assets, long-term assets, physical assets, these are what they go by. For any manufacturing, that is the main, the big ticket item for the capital, right? For the use of the capital. And then the rest of it is called current assets, or short-term assets, or liquid assets, or it's also called working capital. Okay, working capital. Now, working capital, think about it. What it means is literally, think about it. So you raised $10 million. Let's just 10 million, right? 10 million, approximated as 10 million, and most of it, 9.5 million, is plant and equipment. right? 9.5. Excuse me. And then there's, excuse me, difference is, like 0.5 million. Ignore these numbers. These, exact numbers was based on, all the result of all these, small line items. But roughly, just thinking roughly, right? If you have, so let me use this. If out of the total assets of, out of total assets of 10 million, right? If real assets, right, or fixed assets, if it is 9.5 million fixed, real, right, or long-term assets, right, which is plant and equipment, building and land, right? And if this is 9.5 million, right? Obviously, we know 9.5 million, right? The other remaining 0.5 million, it will have to be 0.5 million, which are called current assets or liquid assets or short-term assets, right? And minor line items, right? And these are also called working capital, right? They are called working capital. Now think about it. Just because you have plant and equipment in place, that doesn't mean it generates income right away. I mean, it will. There is a lead time. Think about it. You will need to purchase the raw material, right? You have to have your production workers, right? And then, using your plant and equipment, you start production, right? Of course, workers, right? You have to use workers. You have to use, raw material, and comes out the finished goods, which is the output, right? And then all these outputs, will be, will turn into finished goods, and they will have to sell. And so and when they sell, then the first round of revenue is generated, right? First, first round of sale, and then first round of revenue is generated. And the time until that point, from starting production and until generating first round of revenue, is called lead time. Time it takes, or time leading to the first round of revenue. So it's called lead time. So until then, you have to run the company until you generate the first round of revenue. So you need money to run the company until then. That's why it's called working capital. In other words, this money is the working capital or operating capital, right? That is needed to run the company during the lead time, right? In other words, until you generate the first round of income, you have to pay the workers, right? You have to pay utility, you have to pay for the raw material, etc., right? Now, and then as for the line items, yeah, first thing is, cash and cash equivalent. All these current assets are listed by the order of liquidity, right? By the order of liquidity. And we know what liquidity is, right? Liquidity is, we talked about it from topic 1. Liquidity, basically, there are three levels of liquidity. I mean, in definition of liquidity. First of all, the most basic level means, of course, the how easily you can convert any asset into cash. That's liquidity. On the second level, it means cash flow. Cash flow. Of course, if you have liquid assets, a lot of easily convertible assets, right? Assets that can easily convert into cash, then your company must have a lot of cash flow, right? Now, on the third level, and macroeconomic level, liquidity means money supply, right? But here, it means when I say it's in the order of liquidity, yeah, first meaning, right? First definition on a very basic level. How easily cash is already cash. So it goes without saying, it's the most liquid asset. Cash equivalents are something I'm not going to go over this again, but in the you see in topic 2, there is a separate link about cash equivalents, right? Short-term, modest return, low risk, and low risk, assets like commercial paper that don't change in value frequently as stocks, right? So, I mean, think about it. To be cash equivalent, right? The nominal value of that asset shouldn't change. It should be very constant, like $100 bill. Nominal value of $100 bill will never change. It's $100. But stocks, stocks and bonds cannot be cash equivalents because they change. The face values don't change, but market price. I mean, the selling price in the market changes frequently, right? Stocks, goes without saying. So you can click on the link and read further about it. But the point is, this company has, these current assets are listed in the order of liquidity. Second line item is marketable securities, which means stocks and bonds. Now, this is the source of their investment income. Think about it. The investment income in the income statement, right? It is the result of the marketable securities, stocks and bonds this company is holding. Of course, the stocks and bonds here, in this case, means the stocks and bonds of other companies, not their own. Because their own, first of all, bonds, let's think about the bonds. Their bonds cannot you cannot hold your own bond because a bond is a debt. You cannot have debt from you, right? You cannot have debt from yourself. I mean, debt is from somebody else, not from you. So clearly, that's stocks too. The company has no reason to hold their own stocks. I mean, sometimes a company holds their own stock. It's called a treasury stock in that case. But the purpose is to reduce the number of shares outstanding, so that the price of the stock will go up. Right? It's called a stock buyback or stock repurchase. Stock buyback. If the company buys back its own stock, the purpose is to raise the market price of the stock, because the market price, if there are less total value of equity is, let's say, currently $10 million, and currently if there are 20,000 shares outstanding, 20,000 shares outstanding, right? Then the price per share is $500, right? You can calculate it mentally, it's not a big deal. 10 million, think about it, divided by 20,000 shares, should be 500, right? But you want to raise the stock price artificially, right? So what do? You buy back 1,000 shares. You buy back 1,000 shares from the market. Of course, they will have to pay market price of $500 per share. And if the company buys back 10,000 shares, right? Then the shares outstanding will be only 10,000, right? But the total market value of the stock, total value of the stock equity is still 10,000. So then you divide 10,000 by 10 million. You divide 10 million by 10,000 shares. Then the price will be $1,000, right? Of course, they cannot do it, like in this drastically like this, but even by, this is a very extreme example, but if even by a little, by doing this, they can raise the share price in the market, and that for that reason they can hold their own stock, right? That's called treasury stock, as I said. But most of the times this means stocks of other companies. I mean, Apple can hold stocks of Samsung. Samsung can hold stocks of Apple. I told you they can cross own each other, right? Of course, the share, the percentage of shares may not be that much. Certainly, Apple wouldn't want Samsung to hold the majority shares of Apple. Samsung wouldn't want that either from Apple, right? But at least and why do they do that? Well, even usually they hold a broad portfolio, or companies hold broad portfolio of stocks, broad portfolio of other companies, and they are not necessarily from their own industry. It could be across different industries. It's just a diversifying part of their diversified portfolio. They need to diversify the portfolio. That way, if their industry is not doing well, other industries that's doing well will hedge the right. It's a kind of hedge strategy. if their industry is doing bad, at least their profit will be still the damage to their profit will be minimized, right, or mitigated. Maybe not minimized, but mitigated by holding stocks of other industries, okay, which could be doing well while your own industry is not doing well, right? Makes sense. And even within the same industry, they can have competitor stocks because also the same reason. Even if your company is not doing well, your competitor may be doing well, and then you can benefit from the profit of your competitor. So that's what it means. Promissory notes. I wonder in the last class if I talked about. I don't know. I don't think so. If I did, promissory notes are. Did I talk about this before? Because let me just check. I don't think so. I just don't want. I don't want to duplicate 1013, right? Last class, which was Wednesday, so that must have been a 1 hour class, and then. Five. Okay.
Has to have a plant, right? Yeah. Someone was trying to say something. Was some almost banks have only finance some of it, like let's say if it is $100,000, $10 million, about 9.9 million is that has it has zero value as an asset. So assets are something. It can be intangible good, right? Output can be an intangible margin of $500. But from Dell's perspective, manufacturer's perspective, their output, 1000 Model X, dollar value of that, which is not build anything, but
you can make
if you idle it, that's 60% of the total.
Okay, I probably didn't talk about the promissory notes. So promissory notes are the most preferred, most frequently used payment modality in B2B, business to business. Okay, promissory note is, in essence, is an IOU. An IOU sounds like a IOU is literally a promise to pay. But in personal situation, I mean, if you're borrowing money from your family members or from your friend, you can write on IOU. But how long, how far? I mean, in legal effect, right? How far it goes in legal effect? Personal IOU has, unless it is notarized by a notary public, right? Unless it is notarized, it seems to have very little legal effect. So when you write an IOU to a family or to a friend, it's because they trust you, right? But you cannot just go to let's say an Apple store. You cannot just walk into an Apple store and buy a $1,000 Apple iPhone or $1,000 computer and pay with an IOU. Goes without saying. They will be laughing, right? Why? Because it has no legal power. Now, but in B2B, all businesses use IOU, promissory note. And promissory note is basically one of the think about it. There are 4 payment modalities in B2B. One, of course, first of all, cash, right? Second, you can pay with a check. Third, credit card. Fourth, promissory note. Okay, and from the seller's perspective, seller prefers always cash, because cash is, cash. For promissory note, they will have to wait until the maturity of the promissory note to receive cash. If you pay with a check, it will take about probably 3 days or to a maximum of 1 week for that to clear, for the check to clear, right? And if you use credit card, if it buys you up to 1 month, I mean, the credit card company will pay the merchant, right? Credit card company will pay the merchant immediately, but for you to pay the credit card company, right? It's 1 month. So credit card, from the seller's perspective, right? Cash is the most preferred, then the credit card, and then check, because sometimes a credit card wouldn't take that much time. It would be almost instantaneous between the seller and the credit card company. But check, it would take about 3 days, up to 3 days, but sometimes even 1 week. So from the seller's perspective, the order of preference, right? Order of preference will be cash, credit card, check, and then promissory note. Why? Then why is the promissory note the least preferred? Think about it. Of the 4 modalities, promissory note can buy from the so that means from the buyer's perspective, right? From the buyer's perspective, promissory note is the most preferred payment modality. Most preferred payment modality. And the reason being, it can buy you, if you're the buyer, it can buy you the most time, because promissory notes have maturity, and the maturity is usually 30 to 60 days. It's most common maturity. But theoretically, it can be up to 270 days. Of course, in reality, nobody welcomes such a long maturity, promissory note with such a long maturity, and most sellers will try to collect within 45 days. Okay. So, and then think about it. Suppose the seller is Dell, right? Dell computer. So let me talk about, let's use, okay. So, so here, promissory note. So let's think about it. Promissory note. So suppose there are buyer and seller, oops, B2B, right? B2B context. So let's say buyer is Best Buy. Best Buy is electronics, consumer electronics. Seller is Dell. So let's say Dell's model Best Buy bought Best Buy bought 1,000 units of Dell Model X, and Dell Model X is, let's say, $300, selling for $300. Of course, this is, between the manufacturer and the retailer. This price is, in other words, this price is the price leaving the manufacturer's price, right? This is the manufacturer's price, which is called also ex-factory price, the price leaving the factory. So that means what? The total amount they owe is $300,000, right? $300,000. And they paid with promissory note, let's say 90-day promissory note. They paid with 90-day promissory note. Now think about it. The reason the seller prefers cash is that if they received cash, $300,000, they can at least with this cash, they can put it in the bank and at least earn the average bank interest rate. Of course, it is almost immaterial these days. But during if the bank interest rate is at least something like 3%, they can earn at least 3% interest. But that's taking away. I remember talking about opportunity cost here. Someone asked opportunity cost. So I have this deja vu. Someone already asked, is that the opportunity cost? I think someone asked that in this class. Anyway, so Dell, the seller, will be very reluctant to, and obviously no seller will be happy to receive, promissory note. So, but then from the buyer's perspective, if they can only defer payment for 90 days, right? They can, let's say they can Best Buy can defer the payment, $300,000. Oops. They can defer payment of $300K and invest. And if invest in, let's say, stock N, and the return on stock N is 10%, right, for 90 days. Then think about it. They can use this money and invest it in stock M for 90 days and get 10% return. And from 10% return, they can already pay this 3% interest. I mean, so the issuer of the promissory note will pay offer at least something like something equivalent to the market interest rate to facilitate the acceptance of promissory note. So from if they can get 10% return, that 10% from that 10% return, they can pay 3% interest already, and still have 7% left over. That's why they pay with promissory note. That's the reason. I mean, there's if there's a profit potential by deferring the payment for 90 days or 30 days or 60 days, if they have that option open, right, that will leave them with more profit than paying just cash. That's why the buyers prefer to use promissory note. I believe, well, we are, I know it's my fault. I mistook, I got confused, and so it's been only 45 minutes, but this is, all the time we have for today. I'll try to, but the main lecture has already been delivered by the the pre-recorded videos in the topics folder. So this was discussed already, in the main lecture. So I'm gonna have to call it a day. I'm gonna have to call it a day today, and I will see you guys. I apologize again for today. I will see you guys on Wednesday. Okay, I will be here on Wednesday at 1 p.m. Okay. Any questions so far? Any questions? Okay. Alrighty, I will assume that you have no.
Okay, Professor. Have a good day.
All right, you
Have a good day,
too.
Professor.
Have a good rest of the day, and see you guys on Wednesday. Okay. All righty, I'm gonna stop sharing. All right. Take care, Aura.
Okay, thank
All righty,
you. Bye.
and all right, bye, and I'll stop recording and sign out.